Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending September 6th, 2024. I'm Preston Britt. Thanks for tuning in. Well, the theme this week is markets aren't happy, and they certainly exhibited that this past week. Let's take a look at what happened. You can see everybody solid in the red for the week. Dow, S&P, NASDAQ, Russell, all solid, hard down. NASDAQ and Russell down over 5%, over 5.7%, both. S&P down over 4% for the week alone. Now, year to date, the numbers are still double digit for Russell, NASDAQ, S&P. Dow is still up 7.05%. But clearly, the S&P suffered its worst weekly drop in over 18 months. And it looks like worries over an economic slowdown appeared to kind of weigh on sentiment this week. In fact, it was the worst start to September since 1946. Now, I'll remind you guys that historically, September has been one of the worst months for stocks all year, going back since 1950. The average loss is 70 basis points for the month. But I'll remind you guys, over the past 4 years, not counting this year, the S&P was down 4.9%, 9.3%, 4.8%, and 3.9%. So the past 4 years, and if we throw this in 5 years, because we're already down 4.25% just for this week alone, not very good. Not very good start to a historically bad month for stocks. Now, trading volume picked up a little bit as investors returned from summer vacations. And, the beige book, which is put together for the coming FOMC meeting in a couple of weeks, also had a distinctively downbeat tone. All right, 9 of the 12 Fed districts reported weaker conditions, with only 3 saying economic activity grew slightly. So clearly the U.S. economy is slowing down, but I don't see it dramatically slowing down. If you look at the PE ratio, it's still very rich, a forward PE of 22.57, which is a little over 4% lower than the trailing 12 months. You can see the 10-year Treasury came in at 3.72%. And you can see the earnings yield for the S&P is still a robust 4.88%, okay? And the current VIX had a really strong up week, finishing out the week at 22.38. The prior week, it closed at 15.79. So the VIX, clearly, there's a lot of agita in the markets right now. Now, this past week's heavy economic calendar generally surprised to the downside, all right? And we've already got a almost 100% guarantee, although there are no guarantees in the market, but almost 100% that the Fed's going to be cutting the rates at least 25 bips. That's a quarter of a point in 2 weeks. But, based on the numbers that came out this week, we saw the job openings, the jolts. It came in a little bit of a larger disappointment than the markets expected. It came in at 7.67 million jobs unfulfilled. They were expecting a little over 8 million. But the big number of the week was Friday's official payroll report from the Labor Department. It's kind of a complicated picture. I mean, overall employees added 142,000 jobs, all right? That was below the consensus of 160. But they also revised down July's job gain by 89,000, June and July by 89,000. So that's the lowest level since December of 2020, all right? And the household survey, unemployment did tick down just a little bit from 4.3 to 4.2. And we did see a little bit of a rise in hourly earnings by 40 basis points, a little bit better than expected. So a little bit of a mixed bag on the jobs numbers. But what it did was the markets reacted initially to the upside. And then after they started thinking about, well, what's the odds of a Fed cutting 50 basis points, dropped down to about 25%. After these numbers came out. So that really set the market on a tizzy to the downside. The 10-year Treasury, as I said, appeared to fall back in response to that jobs report. It's hit its lowest level since May of 2023. Okay? So all in all, not that great of a week. Now you can see The sector performance staples, which is a risk off sector, was the best for the week. Risk on technology was the worst, 7.45% down just for the week alone. Utilities moved back in charge for the annual sector performance at 21.83. Okay. Discretionary, bring it up the rear, but still in the green at 2.45%. Okay. Now, if we swing over and take a look at how some of the other major countries perform, you can see everybody was in the red as well across Europe. The ECB said they see a clear case for interest rate cuts in September, but they did not commit to doing multiple rate cuts this year. They just said another one in October was quite unlikely. Now, remember, our Feds don't meet in October. They meet this month in 2 weeks, then they have a month off, and then they meet in November and in December. Okay, now the markets are still pricing in for the US, still 100 bips before the end of the year. And they only got 3 more meetings. So that would imply one of these meetings is going to be a 50 bip rate cut. But the odds were cut that they're going to do 50 bips in the month of September. So it'll be real interesting to see how this thing shakes itself out. Okay. Meanwhile, over in Germany, we did see a slight increase in their manufacturing orders. It moved up just a little bit, but industrial production in Germany fell more than expected. So they're having a mixed bag over there. And weakness in the automobile sector is part of the big drop in Germany. And it makes sense because China is having their issues. And Europe, especially Germany, exports a lot of automobiles to the US and China. And if we go over to the Asian markets, you can see Nikkei, China, Hang Seng all clearly in the red for the week. Japan, their wages grew 40 basis points year over year, boosted mostly by pay hikes and summer bonuses. And it's also bolstering the case that the BOJ is going to hike the rates again this year. We'll see what they do, but I've been bullish the yen all year long, as you guys know. It's, to me, a low-hanging fruit trade. And then, of course, over in the Chinese markets, they're down solid year to date, over 7%. They're having trouble. In fact, the value of new home sales by the country's top 100 developers fell by 26.8% in August year over year. Okay, so prices are dropping dramatically, and that continued slide in new home sales prices kind of signaled a warning impact of the government's real estate rescue package ain't working as good as they think. So they may have to come in and be a little bit more aggressive. Meanwhile, their official manufacturing PMI index slipped to a lower than expected 49.1 from 49.4 in the prior month. So China is having their issues this year with their big real estate bubble that bust. The only reason why it's not affecting Europe and the US as much is because they don't sell a lot of their government debt to other countries to help finance their stuff. They do it all in-house, unlike the US primarily selling a lot of our debt. So in our 2008 crash, a lot of Chinese, Japanese, and European debt holders took it in the shorts, right? But China is more self-contained, their real estate crash. But where it's going to start affecting markets in Europe and the US is the consumers stop buying over in China, which means a lot of the exports from Europe start slipping. Same thing with the US. Believe it or not, we do export things to China as well. And the buying, and Japan also exports. So because China is the second largest economy on this planet, it will wash up on everybody else's shores, but they're going to export deflationary pressures to Europe and the US. So that'll help with our inflation numbers as well as European inflation numbers. Now, what I'm going to do, I'm going to shift the screen over here and just show you guys, maybe you guys have picked something up. What I'm going to show you is a clean chart of the SPX weekly, all right? And it really goes back to the huge drop in COVID in 2020. So it should be coming up on your screen right now. And just to kind of, as a reference, if you can't see it very well, the COVID drop Let me just turn my pen on so you can see it here. We've got right here. So this was, it doesn't even look like much, right? But that was the huge downfall in COVID. And then that 4 trillion added to the balance sheet really jacked up the markets right here. This was our bear market right here in 2022. Coming out of the bear market, as you guys can see, we made a series of higher highs, higher lows, and then we started doing this kind of thing right here, where they were fanning out for the pullback in the markets over here. And this is the current week right here. You can see just how ugly that weekly bar was. As I said, worst week in 18 months. Okay. So again, just as a reminder, this takes us back to 2020 in March when we had the COVID drop. Okay. So let me just clean this up for a second. And this shows you that, you know, percentages can be the eyesight. Let me say it another way. The eyesight can be a little bit misleading. This drop right here looks a lot worse than this drop right here, but it's not, because the base is going from a lower price. So just the back of the napkin, it won't be entirely accurate, but you can see right there, that drop in COVID took us down right around 33, 34%, right? Now, if we were to, let me just get that off the screen there. Well, you know what? Let's do it this way. Let's do the drop right here. So from the intra-week high to the intra-week low, about 35%. Now, if we look at this bear market right here, intra-week high to the intra-week low right there in 2022 in the SPX was about 27%. But if you were to just eyeball this, you would say, oh no, this drop was bigger than this one. But again, the base here is starting at 33.86. The base here is starting at 48.15. Okay. And as you go higher, the bases get a drop of significance. Does not take a lot, right? So now the question is, where do we go from here? All right. I mean, where up here are resistance points? Where do we find resistance up here? And then which one of these key pivot lows is a resistance point on the downside, right? I mean, everybody wants to know. We know what's already happened. All right, but what we want to know is what's going to trade over here. Well, as you guys know, some of you, this will be old school, others, it'll be new for you, but there's numerous indicators that'll help you out with this process, right? So one of the things I want to do is just kind of build a couple of key indicators. Some of them you may not be familiar with, others you probably are. But let's start with Andrew's pitchfork, okay? So if I start with that and click on it, now my system's ready to do an Andrew's pitchfork. I'm going to do the pivot high back over here at COVID, right before COVID, the pivot low right here at the bottom of COVID, and then the next pivot high right here. So now there's an Andrew's pitchfork, and what it attempts to do is show this middle bar, which is clearly in an uptrend, but it takes into account this rapid 35% crash, this big move higher off these lows. And by the way, this big move lower off these lows right here, if I were to do it the other way, right, from that base, right, like that, is almost 117%. So more than a double off these lows right here, right, to get up to this pivot point here. But you can see where this blue line in the Andrews pitchfork gives you some sense of balance during this bear market. Now the next question is, right, well, that doesn't really do good right here. Clearly this upper boundary here in the Andrews pitchfork stopped us dead in our tracks on August the 5th, right, with that big downdraft. And now if we were to just extend this out and look at the numbers, that's right around 5150. 5150, 5200, right in that area. Okay, so that gives you a little bit of an idea of where we should expect some much more resistance. And the other thing you want to do is use a different color pen and just say, let me look at these key pivot lows, because you use a weekly chart to help with pivot lows. So we've got a pivot low here, right, that was after that August 5th crash at 51.19, and then this pivot low here on this initial pullback in the month of April at 49.53, right? So these are going to serve as lower end boundaries before we resume a higher move, unless we move into a bear market, okay? And to give you an idea, just a back of the napkin again on that move right there would give us roughly about to that lowest pivot low, just a little bit more than a correction, about 12.7%, okay? So take it from 49.50 to 5,000, roughly in that area there. You do not need to be precise in these things. Now, the next thing I want to do is do Fibonacci. But remember, this is a bear market right here, all right? This was an official bear market, and we've officially moved into a bull market, right? So that was a bear market event. This was an official bear market event, but many would argue that it wasn't a real bear because we moved back out of it. It was almost a V bottom here. And because of COVID, it was artificial. But this was, in fact, a bear market to digest some of that big move right up here and $4 trillion. And then it level set it itself. And then we started making a series of higher highs as we've moved up. And a series of higher highs, higher lows. I mean, that's the definition of a trend, right? So now, the other thing I would do, just to add to this chart, and let me just erase the drawings here and come back here, is to put a regression channel in here. So I would put a regression channel in here, and I would start with the lows there, and I would come in with the peak there. And there's a regression channel where it doesn't stay up at the blue very long, and once it gets down to the red area of the regression channel, it starts to become a buy. In the middle is kind of like an equilibrium for this particular upside vector, okay? So you can see we're just slightly below, and given the nature of these rapid V bottom, this was a V move right here, right? I mean, you could clearly see this V move. If I would just move out, and you don't usually get a V move like that. That tells me it was an anomaly with the Japanese yen carry trade, and then buyers stepped in. This showed a lot of buyers stepping in right here, right? And then up we go right up here like that, and then a little bit of this move back here. So the next thing we're going to want to put on this chart as we build this thing out is a Fibonacci extension. That gives us, well, where are the resistance points higher than this price here? Because we're all up in dry powder up in this area here once we pass this high point. And again, just to mark it, the high point in the SPX year to date is 56.6967, okay? So where do we measure that? Well, we want to take into account this prior bear market. So a extension must include the pivot high and pivot low of the previous bear market. So if I were to just plug this in, and let me just see it right here like this. Let's go here like this, and then come back down like that, right? So now this yellow line or orange line was the pivot high. This line was the pivot low. And then it does Fibonacci extensions. And I did them as thicker bars, right? Here's purple, here's green, red, purple, and then this one right here. And I'll blow it up just to show you guys. So this shows you where the resistance points are once we get over this orange line. And you can see as we're moving up from the 38% extension, 50% extension, 6.18 extension, and then finally the 200% extension, right? Now, these are valid numbers here. What I probably should add in there is the 0.78. So if I were to just edit this, let me just see here, and let me just put in here. Let's go 2%. Let's do this right here. I'm going to do 2, and I'm going to add another extension in. It's going to be 1.78, which is a popular extension. Let's close that out. So this 1.78 is at 58.15. And if you've noticed, a lot of the gurus, I don't want to use the word, I use the word loosely, but a lot of TV analysts are saying the range for the year-end close is anywhere from 56 to 58. Well, if you look at this fib extension of 61.8. It's sitting at 56.04. And the next fib extension is 58.15. And as I told my members, I'm saying the year end should, assuming we don't have any surprises with the feds or inflation, we should finish between these two benchmarks, 5,600 and 5,800. So that is how that upside target is generally built using technical analysis. Now, the fundamental way of doing it is you got a lot of hedge funds that have a lot of quants and PhDs, and they do a bottom-up earnings per share analysis, and they do a discounted cash flow, and they come up with a proper PE multiple, and then they take that price to earnings multiple, a midpoint of an average price earnings multiple, and then they do some division and some other calculations and then come up with a price. And that has also put the price anywhere between 56 and 58. All right. So that seems to be where the bulk of the analysts are coming in. Now you're going to have the outliers that say we're going to come up to 6,100. You have a few that are saying we're going to finish around 55, 54, right? But again, I'm looking at anywhere from 56 to 58. All right, that's kind of what I'm looking at. Now, the only other technical indicator I have not put on this screen is a Fibonacci retracement. I've done the extensions, right? I had to do them. Now a retracement. Now with a retracement, you do it from the prior pivot low to the pivot high, but this was the V bottom. And this is where a little bit of judgment comes into play. Using a weekly chart makes it a little bit easier, but clearly this right here, let me just back out a little bit, put a little bit of context in this. So clearly this bear market, I could do a fib extension off of this. So I could come in here and I could just hit this low right here again, come up and hit the high right here like this. And now you can see the fib extension, and this small green line right here at 0.23% is roughly a fib retracement off of these highs. And then the next one is 0.38%, taking us down to 4,800, okay? So I've got, I think, enough lines on the screen to confuse everybody, but this is how you want to build a technical chart. You start with an empty chart. Now, I can always add a whole bunch more. Some people just overanalyze this stuff. Sometimes you want to look at volume and see what's valid or not. And again, I'm using a weekly time frame. You can zero in swing traders and others to look at these and look at it a different way. But now you can see all these lines, which are going to serve as resistance and our support points. So looking at this, 5,300 seems like a logical, strong, solid support point. Now we closed SPX right up here right at about 54.08 roughly. And I'm saying 5,300 would suggest a little bit more downside. Be ready for a rally up and then a roll back over again. We got to watch that very carefully. Now, if I wanted to zoom in a little bit and put it on a daily chart, again, we're looking at the SPX. You can see here with these lines, the thick bars are the extension fib nodes. The small bars are the retracement fib nodes, right? And the first small retracement node is slightly below, acting somewhat as support of the August 5th down move, right? So now what we can do is look at this and retrace this, just this piece right here. And just not to further complicate things anymore, if I were to come in here and let's do this. Let's do this retracement from here of that August 5th down mode. Now you can see I've got a 50% retracement here, and I got a 61.8 here, okay? Generally, in short-term retracements, if you stay above the 61%, that means the prior pivot low, i.e. the August 5th, is not going to be taken out. The odds favor finding support at or above the 61.8. Now, the 61.8 is at 53.30, and the 50% retracements at roughly 5,400. So we're close to finding our support. unless we get surprises. This week on Wednesday and Thursday, we get CPI and PPI inflation data. I'm expecting those to come in soft, which means they'll be basically bullish for the markets. And then the following week, we have the Feds flip a coin on how the markets are going to react. I will remind you that the Feds, this is a quarter end, so we're going to get their dot plot, which means they're going to revise going forward how many rate cuts are they going to do. The markets are expecting 100 basis points this year and at least 100 basis points next year for a full 2%. We're sitting currently at 5.25 to 5.5. That implies 4.25 to 4.5 before the end of this year, 3.25 to 3.5 by the end of 25. So that's a lot of rate cutting, right? And as I tell our members, be careful why they're cutting rates. Are they cutting them because they can and they're going for a soft landing? Or are they cutting faster because they're afraid the economy could tip into a recession? So that's why if they were to do an emergency 50 bip rate cut in September, I think the markets may interpret that negatively, not positively. They're overreacting to the possibility of a recession, and that could give us a bigger sell-off. So anyway, that's how you build a chart. That's how you look at it, right? So I'm just going to take all of that off the screen, but that's how you do it. Now, for our members, what I've been posting for them, I said, this is our expected support zone. I've had this up here for at least a week, week and a half, because this is an Elliott wave 3 down. And that's kind of what I'm looking at. You can see this 53.62 right here. And the one thing I did mention is if you have different technical indicators near each other, like this extension and this retracement, they're almost overlapping. They're called areas of congruency, which means that further strengthens the support and or resistance depending on which way we're approaching it from. In this case, it would be support, right? And that's like from 53.22 to 53.11. I like to round things, so call it 53.25 to 5300, because as you know, markets don't hit the exact number. They always overcorrect both to the upside and downside, okay? And that August 5th pullback here intraday was a little over 9% very quickly. You can see these gaps, which have all been filled as we move back up, okay? So anyway, that's just a real quick and dirty of what I'm seeing here. Now, if we were to switch over here, let me go over and take a look at the VIX, all right? So let me just switch the screen here. And let me just shift you over to the VIX gauge here, right over here like this. Here we go. So if you look at the VIX, it'll take a couple of seconds to come on your screen. This is a daily chart. You can see that the VIX gap back up into our light rose colored area, which, you know, it's over 20. And the VIX has a hard time holding these levels up here. And it implies a large move every day. I think next week it's going to calm down a little bit. It should drift back into the high teens, be an older teenager, I guess. And you can see this candle here on it. It shows a little bit of confusion, you know, not quite a gravestone doji. It'd have to be up a little bit higher. But it does show a little bit of confusion in the VIX. I believe next week it's going to drip down a little bit. If we look at the front month volatility skew, you can see here we're in the red, but not by a lot. So the markets aren't too concerned. And if we look at the back month vol skew right here, you can see we're still in the green. So the markets realize, yes, the economy, the rate of change of the economy is going south, but it's still in the green. It's still growing, right? And the consumer is still spending right now. So those things are helping, and revisions to earnings per share are coming in at or above normal. Q2 was strong earnings. So they revised down Q3, but in line with 5-year averages, right? So things don't look bad right now. They can get bad, and the Feds have to be very careful with this, but the unemployment rate helped the markets and helped the Feds justify a 25 bip versus a 50 bip rate cut, which is what I'm believing they're going to do too. And then, of course, we come down here and look at the 10-year Treasury. You can see the 10-year Treasury. The higher it moves, it came up near the August 5th high, right? That was the really big, large dislocation of the markets to the downside. And you can see same thing happen here. So any dislocation to the downside, money rushes to security and risk off, i.e. bonds. Remember in 2022 bear market, it was just the opposite. People were getting out of everything. But in this case, we've gone back to some semblance of normalcy where money goes into bonds in a tough down move in the equity market. All right. If we come over here and we look at the currencies, the dollar, while up a little bit on Friday because it was a risk off day, the dollar's going lower, guys. I've been saying this for quite some time. You can see here the 2024 high was the dollar was on May 1st, series of lower highs, lower lows. It's going to get uglier. You want to be long the euro, right? The euro, now the euro is down slightly, but you can see the euro is just the opposite of the dollar. The euro is about a 57.6, 58% of the dollar index because it's really not the dollar. It's a dollar index on a basket of currencies. Primarily the euro, yen, pound, Canadian dollar, Swedish krona, and the Swiss franc, right? But the yen is almost 13.6, and the pound is 11.9. So you add those three up, and that's pretty much the dollar index. And speaking of the yen, let's go take a look at my favorite long trade here. The yen, I was telling everybody to get long the yen back over here. I included that here in this free update for you guys on our weekly roundup, and there it goes, right? This was what we call a low-hanging fruit trade. Now, I said the upside, the initial upside here was this level right here. And I've had this on my chart for quite some time, right? Right around that area here. We're going to run up here, then we're going to dip, and we're going to consolidate for a while, and then it's going to move up again. I remember the Japanese, they're coming out of like a 20-year funk. They've had their interest rates at zero or negative for too long. And that unwinding of the yen carry trade, which happened on August 5th, really upset the market. They surprised the markets, but now the markets are better prepared for it. I don't think that yen carry trade is completely unwound, but the big part of it is, and that hasn't been unwound has been hedged. So we're not going to get that yen unwind carry trade debacle that we got before. But there are other things that are floating around out there that aren't beknownst to most market participants that can upset the apple cart. But for now, I like the yen to the upside. Okay. If we come down here and look at gold, longer term, I like gold to the upside. All right. You can see gold is flirting and their new highs up here that made the new high on August 20th up 24%. So gold is consolidating right here. Remember, in really bad down moves, you would think people rush to gold, but people are making margin calls and things like that, or having to meet margin calls. So they're selling some of their core asset base to get out of it. But gold, I think, is going to go higher. I think 3,000 in gold by the end of 25 is a doer. 3,500 to 4,000 at the end of 26, 27 is a doer for gold, right? Silver, meanwhile, now look at gold. Upward vector in the 200 and the 50 EMA. Gold is up near all-time high or 2024 highs. Let's take a look at silver. Silver is just the opposite. Silver is not even above its 50 EMA. It's making a series of lower highs and lower lows. It's going in the opposite direction, and very rarely does silver and gold move opposite like this. It does not last for long, which means gold is probably going to pull back. Silver will go up. But if you trade do a pair trade where you're long silver and short gold and you do the proper allocation, it can be a very interesting trade, right? And we're covering that. We're going to cover that. Members, I'll cover that with you on an easy way to do this using ETFs, right? SLV and GLD is one way to do it. Or you could do the futures market. If you look at energy, and if we look at oil, it's hitting the high 68 level. Right, my target was down here at 65, in the middle right here. We're coming down to my target, right? That's where I think we're going to go. In fact, we could go lower. Now, remember what I was telling you guys a few weeks ago. I said oil coming down is a prognosticator of global economy, right? And if there ever was a reason to be concerned about the global economy. I mean, we bump, 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 bump. That's a clear case of that kind of channel just moving lower. And you can see the MACD as it's crossing, it's making lower crosses. We're probably going to hang around here for a while, and I think it can go lower. Oil. Oil is a good prognosticator of the global market. Another one is copper. So if we were to come in here, let me see if I can't find copper for you. I know you're in here. Where are you? Where'd you go? Let's see. Well, let's look at natural gas. As long as we're looking at energy first, we'll look at copper later. Um, so if you look at this, you can see here that nat gas is probably going to roll back over again. My initial target was down around 177. We came down to 185. I do believe longer term, nat gas is going to move lower. All right, it's going to move lower, and with that move lower, then we're going to look at switching over and looking to go long again, but not right now. Right? I mean, it's just not something I want to do right now. And of course, if we look at copper, as I said before, it's another good prognosticator of the global economy. Again, same pattern: down, up, another down. So all of these are showing that the global economy is slowing down. I don't think it's going to be a crash. I'm calling for a market crash, but not until 25, 26, 27 timeframe. Members, I'll give you guys a heads up when I start to see credit spreads widening and getting a little bit ugly. Right now, it's not bad, right? It's just not bad. So anyway, guys, that's a little bit about what we're looking at for this weekly roundup for this weekend. Good college football on today. Great games on, pros starting up, so that's always a good thing. Members, I'll see you Sunday night for our weekly market watch. If you're not a member, highly encourage you to come in. We got some great trades that last for a while. You can make some good money in them. Otherwise, have a great weekend, everybody. Ciao.